Bad thing, I added a word to the title because I realized I was one of two finance talks, so I should put finance in the title, because I'm going to say a few things about, and I also want to leave a lot of time for questions here, so, and I'm also standing between you and the coffee break. So I want to say a few things in general about financial markets, which makes them a little different, I think, and then actually show you some results that I think relate to kind of questions about model evaluation. I will do a kind of curious thing. I actually have a talk with, I almost never do this, I have a talk with no financial time series displayed in it at all. So you're going to see lots of ones sitting behind it, but not in it. Of course, quick background, agent-based financial markets. You guys probably already know all this stuff, but I want to emphasize certain parts of it. One of the things is, of course, in these things, what we're doing is trying to generate entire price time series. I think that puts us aside in the world of endogeneity. 80% of the environment here is completely endogenous. There's not, we have a bit of trading structure on top of them, but so much of this environment is what we're generating. That's important. And also which many of these just refer to that. The last part on heterogeneity, of course, we're all after endogenous heterogeneity out there. Finance heterogeneity is kind of a blessing and a curse. A lot of heterogeneity can lead to a lot of volatility, uncertainty about where prices are going. But at the other extreme, the good side of heterogeneity is actually an essential fuel to make financial markets move. Without heterogeneity, no one will trade with each other. And these things sort of freeze up and you can just watch them die. So there is sort of, it's one of these places where you kind of want an optimal level of heterogeneity, and it, of course, I think moves through time, and that's the whole kind of exercise here. Lots of this conference is about something near and dear to my heart, although using differing tools about how to construct agents. I thought in the finance community, it's actually, it's almost done its own inverse generative stuff over the last 20 years of trying to figure out what works and what doesn't work. I'll say some more about it. We've dealt with hardwired strategies where there's really a couple different styles out there, sometimes very empirically estimated at the micro level. I myself have dealt a little bit with these more complicated adaptive strategies, most recently using linear forecasts. If you move me back in time, I end up using neural networks. Move me back in time a little bit more, I was using classifier systems back with the old SFI stock market. There are others out there who use genetic programming. You might notice that as AI moves forward, I seem to move backwards. I just leave it at that. I don't know what's going on with this. But actually it is. I'm moving to sort of, I find some of the more difficult, there is an element of tractability still necessary of getting to some of these simpler things. And they do generate much of what the more complicated systems did before. I kind of was working to find out what worked and what didn't work. What do these models do? If I were to show you some time series, this is the philosophical side of time series. These agent-based models in finance have been incredibly successful at this macro level. They've generated things that look like stock returns, time series with basically very low autocorrelation. This is a big feature of financial markets. Distributions of returns are fat-tailed or leptokurtic, if you want to be technical. And a lot of, Chris showed a little bit of volatility persistence. There are periods of high volatility, low volatility. These are targets that standard models in finance have no capability really of reaching very well. And then in the agent-based world, we do it kind of too well. This comes back to the integrative ideas of there are lots of models that actually generate this. I actually made a forecast in the mid-90s that we would have a lot of models that we would almost have too many models that were capable. I wish I wrote it down. I wish someone was recording it. My only successful economic forecast ever was that this space would be pretty full, and it is. So one of the things about this talk, I'm going to try to show some ways of identifying across these. More advanced models look at price-dividend ratios. These are the sort of bubble-like stuff. Trading volume has always been something very near and dear to my heart, also in terms of creating these things. Agent-based models give you that, and usually pretty realistic. And as I said, many models replicate these things. So we actually have a kind of problem here with almost too many models. If you talk to an academic finance person, those were all time series things. And they're sort of known in the agent-based finance world. They say, these are the stylized facts. If you talk to a regular academic finance person, they're totally confused because they don't really care about those that much. A little bit, but they don't think of models that generate. They don't meet any of Josh's criteria about, but that's academic finance. But they think of a different set. They think much more about cross-sectional results, of which agent-based models, for various reasons, usually ignore. This is much about correlations in the cross-section across different stocks. And these are important. People think about factor structure. There are interesting things that happen during crashes. Markets become highly correlated with each other. Stocks become correlated with each other. There's a phenomenon known as crowded trades. Everyone sort of seems to be making similar trades. Things start to become correlated with each other again. And another big topic is the space is being of financial institutions being taken up a lot by index funds. These are passive funds that follow very mechanical strategies. This is question number one that's asked to me, say, in the past, say, 2 years or so. What do agent-based models tell you about that? I think they do tell you some things about that. But the agent-based models have generally stayed away from this. I would say some of these features are not all that stable, as the other ones are extremely stable, very robust. And another final one that I look at a lot is the flows into mutual funds. It's a hugely big stylized fact. Mutual funds, we can measure when investors are coming in. They come in, all they do really is respond to past performance. Mutual funds been doing well in the past. Funds generally drive into that. That's a fairly easy thing to calibrate models up to. So what I'm going to argue for in terms of, this is where I get to these gradients and sort of learning models here, and not arguing for looking at time series. I think sitting below almost all of these models in a lot of agent-based modeling and finance in particular are these learning gradients. We talk about it a lot. You know, these for me are going to be in finance. There's some sort of performance measure. There's some fitness measure that we're looking at. In finance, they actually depend on returns and variances. But if you're kind of general complex systems person, these are, of course, fitness landscapes. Yeah, Sewell goes back, of course, to Sewell Wright kind of coined that term. So this is sort of Sewell Wright finance is what I kind of do, which is a little interesting, curious. But we think about these, but I'm going to argue they're just core to what's going on. I was going to show you two applications very quickly, and then I'll sort of wrap up. The first one's very simple. I'm going to use it as a kind of consistency check in a model. This is something I just sort of put out a paper on this recently. I'm going to take a very simple agent-based model that is what's known as a HAM model, heterogeneous agent model. This is a very standard core model that people use in finance. It actually only has two types in it. They have fixed parameter rules, and the idea is agents slosh back and forth between these two types. One of the key ones was one built by Brock and Thomas. Thomas Lux has built some. Late Carl Chiarella and Tony Hay, also a couple other people. These are simple enough, though, that they have been also, to this group, been used to estimate and fit these macro features. So you're taking a fairly simple, not that many parameterized model, fit those to the macro features. And what I do is I measure the gradients at these given parameters, the objective gradients of the trading strategy here, or sort of utility, sort of fitness landscapes at the given parameters. And this model, I think, as a consistency check. And I'll sort of put up the picture and tell you how I'm doing that. But this model is going to actually fail these consistency checks. This is an example. This is basically one of their parameters. This is a price forecasting parameter. They are trying to forecast, this is a very simple model. It's trying to forecast the price as a function of the past price based on this little parameter phi. The parameter phi is actually their best value of that to fit the macro data is 1.07. So this is actually known for them. This is an unstable forecast out there. There's a stabilizing forecast on the other side, and there's a balance very much like feeds into Rob's talk a little bit. You've got these two forces going against each other. But if you look at the measure, would these guys want to change? They don't ask that question. The model is locked down. They don't ask the question, would you want to do some sort of local exploration? Josh has brought that up, and it's come up a couple times here. And the answer is basically on that blue line and that dashed line are the upward sloping things. There are two different experiments agents might do to think about changing their own little rules. Would you want to do it? The answer is yes, because your objective function is going up. It's not flat at that. So they're technically would not be happy with that local rule. They would start to push that parameter up. So I think at the micro, this is a kind of micro consistency check on this gradient. that this is not a micro-consistent model. They would want to change. If given the option, you have to ask the question, is there something that's holding them back from changing? And, in finance, I don't think there's a reasonable constraint like that. You might be curious what the downward sloping thing is. That's actually an experiment where, well, the upward sloping ones are purely individual agents thinking about doing it. The downward sloping one is if the entire population changed that. This is actually kind of a Schelling-like, one is the micro change, the other one is the macro change. And of course, if they all change, they actually move the market to a less stable position, increase volatility, and nobody's happy. So it's a kind of cool little experiment. Well, let's try to do an application that gets a little more sophisticated on this and move to some data. Can we now use this sort of gradients to check data out there? And we're going to look at a sort of more sophisticated agent-based model. This is here, I'm going to come to this sort of also do with this in volatility space. So these are different volatility forecasts. Agents are going to be building portfolios between stocks and cash. This will be their portfolio up there. They've got a utility function here that depends on returns and volatility and some estimate of risk. This is one of the key things that I think makes finance, for many reasons, I think this makes finance a bit of a tricky world to operate in. And then they're going to obviously have to forecast expected return. I'm going to push that exciting part off to the side for a lot of this and deal with the adaptive volatility forecast that they've got here. They're going to be forecasting volatility using a basically adaptive forecast which says today's forecast of volatility is today's volatility plus some weighted average with yesterday's forecast. It's a standard kind of filtering, sort of adaptive filtering system, very simple, very basic to time series out there. This thing, omega, defines the fitness. This is really the weight that they put on recent stuff. It controls how they do their forecasts. So those weights, you can imagine this here. This is time into the past. This is how two different rules would look out there in this space. The blue one's got a half-life of 10, so it's going puts much more weight, stuff farther into the past. The orange one here drops off much more quickly with a half-life of about 5. It's decaying much faster. This is someone who's just using very recent data. The other one using much more data from the past. That's going to be our landscape there, is going to be looking across those types of strategies. Now we can look at many different half-lives. And what I'm going to display here is an experiment, no model yet, no agent-based model. This is the data. Stop that. This is the data out there. And this is the fitness landscape for several different levels of risk aversion on the data measured. These are the half-lives of these different rules. And you can see this would be the landscape that these guys are crawling around on. So there's obviously a nice sort of peak there. The types of rules that would stabilize this market will be way far out on the right side. That says use lots of data, you put a very long average on what's going on, and that would generally sort of stabilize things in the market. And it appears not all that sensitive to the level of risk aversion, but there is an interesting hill there. And think about we're going to really drop adaptive learners on top of these surfaces, although we'll fix this to just gamma equals 3, the level of risk aversion at 3. And so we're going to run an agent-based model now. That was the real data. That's pure data. My argument is I'm going to go back and forth sort of between data. Now we're going to sort of use this as a target, not time series features. I want to use this landscape kind of as my target, not time series, yes, obviously fit all the time series, but I want to get at that landscape too. So we're going to look at an richer agent-based model. I won't go into its details too much. It has sort of reasonable rule sets. Agents will be periodically choosing over rules, I think similar to what Chris was doing, sort of an asymmetric fashion. They wake up, change rules. And of course, all the heterogeneity in this market is completely endogenous. These are very simple models that have a risky asset, a risk-free asset out there. Those are calibrated up to aggregate US data. The risk-free is going to pay 1% real in interest rates. And a key thing about agent choice, where they determine their utility functions are well-defined, that will be their portfolio choice. This is the fraction of wealth you put into the risky asset. And it depends critically on these two things. The risk-free is just fixed, that's RF, but it's the expected return, that's that first little expectation up there, divided by the variance. Any function that sort of puts a, increases your holdings based on expected return and decreases them based on risk will generally do here. I'm not going to go into details of the different rules. There are different types in there. There's a trend following, fundamental, that's sort of a mean reverting strategy. There's a short-term, one that's looking for short-term reversals to trade off each other. And there is a passive index fund type thing in there. They're in there for each of these are in there for very, very, very strong, purposeful reasons, both for generating data and for answering certain questions. Come back and ask me about some of those pieces. But we're going to go right to volatility. They use the adaptive forecasting and volatility with differing gain levels out there, just as I had before. There's a pricing system underneath all these kind of financial systems. That's part of the details of these things. This is used as a kind of linearized pricing system. I won't go through the details on it, but they are essential to actually making this go pretty fast. I'm borrowing a system from mostly coming from evolutionary finance to this. Also, it's a system that can be easily extended to multiple assets, which you can see from some of those questions early on. I'm sort of heading in that direction eventually. This is a kind of key thing to this rule selection, speaks to the rule selection. They wake up every so often, each agent wakes up every so often, looks out at that set of rules, and makes sort of a calculation of whether they want to switch or not. So they evaluate the kind of utility function of each of the strategies. All strategies have to report their actual utility, what their returns and variance would be. Agent gets to evaluate that. And this is part of many agent-based models. They're going to evaluate some difference of what I'm currently doing versus what I might do. That has to get fed into some dynamics for how the population moves around across those rules. And I use a standard discrete choice logistic function for that, which generates the probability of a transition given that utility spread. So the new one is, if they're basically equal, this moves basically 50-50. If one starts to lead the other, you increase your probability. So this is the stochastic search going on. This is part of almost, at least in finance, it's part of almost any agent-based model. It doesn't have to be a logistic function. Could be some other sort of random search out there. So sitting in the middle of this is this really critical parameter. I think of it actually as the Achilles heel of agent-based models. And that's beta out there. That's known as to, at least in the finance world, we think of that, and the actually microeconomics world, the intensity of choice. So it maps differences in utility, sort of an abstract concept, into probabilities of moving agents around. A real concept and that is a notoriously difficult, some people have brought up the word identification, that in econometrics, critical issue. It's a very poorly identified parameter out there. This is a tricky parameter, critical to the dynamics, but very hard to identify in estimation. Many people just sort of punt on that. So I'll show you some simulations, but I promise I will show you time series from simulations. We will set intensity of choice initially to 500, coefficient of risk aversion, that's gamma, that's going to be 3. We're running with about 2,500 agents here. I will eventually reduce the intensity of choice, and we'll see something. So this is at the sort of 500, fairly heavy intensity of choice. They're moving a lot on that. These would be returns. These are weekly returns. They're actually quite uncorrelated, and you can see these pockets of volatility out there that Chris was talking about. Now, how about the gradient? I was talking about this surface. Here's what it was in the data. I just wanted to remind you what that is in the data. I can estimate that in this model, too. This is binned, 5 different bins, but I'm estimating this off my data. Not perfect fit, but not bad, with a kind of max around pulling about 30 or so. Now remember, this doesn't mean that all the agents are going to collapse to there. They're doing a stochastic search on this thing. So I think of them, this is just a general, guidance landscape that they're moving around. They should be packed, around there, and they're generally not going to get dragged out to the part that sort of stabilizes this market. That's what gives you the dynamics in this thing. That's what's really driving it. This is really critical, and we're now doing a pretty good job of lining up with the kind of gut picture we're seeing from the data. And now, just quickly, what happens if we go to 50 in this? It actually generates a slightly more random-like pattern, shuts down a little bit of the volatility persistence, but not all of it. There's still some in here out there. When we look at the landscape, though, the fitness landscape across these volatility forecasts, very different shape. There's a bit of a blip at the early part, and then a sort of long upward slope thing that is generally going to drag a lot of the little wandering around agents up that hill. And if you look at their wealth distribution, does it do it? This is the distribution of wealth across the different types of strategies. That's critical to what drives the dynamics. This is the critical state variable in this. Where is wealth sitting? That landscape is pulling them off up to the sort of stabilizing side, giving you a very different result in the dynamics. So my argument is that this thing here, these landscapes are so critical, and we should be spending more time looking at them to help us discern as a kind of model selection tool. So I showed you, the basic empirical features do not identify models very well in finance. We have in this kind of answer to this integrative problem, we have like a ton of models out there. So we need some other things to help us identify what's going on. And I really think I'm arguing for going under the hood, get deeper into the model dynamics. We still have a lot more stuff we could be looking at. We just don't know quite where to look. I think these learning gradients are a way to look. They actually can be used as a consistency check in models. They can be used for model identification and estimation. And what makes them critical is they are this link between the performance or the fitness of different rules and agent dynamics. And that's kind of key to a lot of stuff in this entire field. It really, to me, you can't sort of ignore that. Okay, thank you.
Time for a question or two.
Well, marvelous talk, as always. I love your stuff. It's very fascinating, cool. I was curious, as you were talking about it, the intensity of choice, right? You say it's poorly identified. I'm just curious, could that be, I know it's already poorly identified, so this is probably an even worse idea, but could that be an endogenous element? I mean, it's kind of like, looks more like a sort of a temperature to me.
Yeah.
And it might be something that is itself.
Well, one of the, it reminded me of another thing I wanted to say. So Josh, thanks. I was another, in these seas of parameters, one thing, of course, you want to try to, one mission was often to endogenize much of the stuff you could, put it under, I used to say, put it under evolutionary control. It could be, it does add a bit of complexity to it when you start to do that. Sometimes it depends how much you think this is some innate part of people's decision making that they don't change. I have certainly done diverse populations. Risk aversion is the one that I'm always doing, which is natural, and it doesn't seem to matter that much if you put in a reasonable range of these guys. If you really spread the range on risk aversion wide, certain types will, of course, take over eventually. But the intensity of choice, I've done a little with it, but not as much. I don't think it's a great place to do.
Yeah, okay, not a great idea.
Any other? Well, maybe we need some coffee to stimulate some discussion on a plate. So